Hello, welcome to the European Open briefing for Friday, November the 3rd. I'm Rafi Boyajan, currency analyst at XM.com, and we're going to be taking a look at what's happening in the currency markets today. The US dollar is broadly flat this morning. We didn't see much of a response in financial markets yesterday apart from some knee-jerk reactions to the unveiling of the Republican tax plan, as well as the president's confirmation that he's nominating Jerome Powell as the next chair of the Federal Reserve. We've got US jobs data coming up later. The non-farm payrolls report for October is due later in the day, so that might give some fresh impetus to the dollar. The pound, though, is sharply down. It plunged yesterday after the Bank of England raised rates, but gave its outlook on the rate hike path fell short of expectations. The Australian dollar is another loser this morning. It's down after retail sales numbers out of Australia disappointed. Let's first start though with the US dollar. We can see dollar yen. There was that brief tumble yesterday after the unveiling of the tax plan before recovering back up again. It's currently steady around 114 yen. Dollar index, we can see, has been broadly flat since the start of the week. So we had the unveiling of the Republicans' tax plan. A lot of the good points were already leaked, such as the corporation tax being cut from 35 to 20%, the income tax brackets being brought down to just 4, the introduction of a new repatriation tax of 12%, but the negatives were actually a bit worse than what was expected. There are fears that there could be some significant impact from the removal of quite a big number of tax breaks and the elimination or reduction of many state and local tax deductions, which could have a negative impact on households' incomes, as well as there's the obvious concerns about how quickly these will now be passed through Congress, and and what kind of changes will be proposed to this plan, and for example, whether they will try to have the corporation tax being brought in through phases, or try to ease some of the impact from the removal of the tax breaks and so on. So that has pretty much had a mixed response by the markets, and so has the nomination of the next Fed chair, Jerome Powell. He will be replacing Janet Yellen when her term expires in February next year. There were already widespread reports that Jerome Powell was the likely candidate to be appointed by President Trump. He will now have to be approved by the Senate. The main story here is that his appointment now breaks a near 40-year precedent, which previously all previous presidents had reappointed the existing Fed chair. So Janet Yellen is the first Fed chair in 40 years not to get reappointed for a second term. Although given that President Trump likes bringing in change, and that the fact that Janet Yellen is a Democrat, his decision wasn't too much of a surprise. But there was widespread relief in markets, particularly in equity markets, that a more hawkish candidate like John Taylor wasn't appointed, although the position of Fed chair is still open, and it is possible that John Taylor could be appointed as a vice chair. But we did see Treasury yields falling back a little bit after that confirmation, because of course Powell is likely to follow similar policy as Yellen, both of which are in favor of just gradual increases in the Fed funds rate. The main focus now will move on to the non-farms payroll report. The economy is expected to have added 310,000 jobs in October. That's a very big rebound after that bigger than expected drop last month, where the economy shed 33,000 jobs in September as a result of the impact of the hurricanes. We should keep an eye on wage growth. Last month it rose to 2.9%, although it is expected to ease back a little bit this morning. Still, we could see some response to that if it comes in stronger than expected. Let's have a quick look at gold prices now. We can see gold prices have been firming a little bit over the past week as treasury yields have been falling. We can see that strong correlation as US treasury yields, the 10-year yields rises. Gold fell sharply in late October before recovering a little bit again. Yesterday it hit a 2-week high of $1,284 an ounce, though the outlook is pretty much neutral at the moment. Just something to keep an eye on. There is a possibility that North Korea might conduct some form of missile test or nuclear test, given that President Trump is due to visit the region for an 11-day trip. He will be visiting 5 countries there. So this would be a typical opportunity for North Korea to do something to ruffle the US's feathers. Let's now move on to sterling. We can see here in the daily chart, sterling, that big one-day drop. I think that was the biggest drop in several months for cable. Although despite that big fall, it managed to it didn't manage to break below the October low. So there seems to be strong support just above the 1.30 level. If you look in the hourly chart, we can see that the pound was trading around $1.33 earlier in the day before hitting a 4-week low of 1.3037 earlier today. Against the euro, it hit a 1-week low of 0.8937 and a 2-week low of 148.65. Against the yen, the Bank of England, as expected, raised rates by 0.25 percentage points to 0.5%. The actual vote was much more hawkish. We had 7 MPC members voting in favor versus expectations that only 6 would do so. However, looking in the minutes and in the bank's inflation report, the bank does signal that they will be raising rates in line with that the path implied by the market yields, which means 2 more rate hikes over the next 3 years. Previously, the bank had said that interest rates might need to rise faster than that implied by the current market yields. So markets took this as being very dovish, and that's what triggered that big sell-off in sterling yesterday. The expectations are that the bank won't be raising rates until late 2018, which means that over the next few months, the pound could possibly be very sensitive to what goes on in the Brexit talks. Also, although the Bank of England dominated the headlines, there is a possibility of fresh political trouble for the Prime Minister Theresa May after choice of the new Defence Secretary following the former Secretary's resignation on the back of a scandal. Her choice drew strong criticism from senior Conservatives, and once again that highlights the fragility of the UK minority government. Quick look now at the Australian dollar. We had retail sales numbers out of Australia. Retail sales were unchanged in September. Expectations were for a 0.4% increase, though the prior month figure was revised slightly higher from 0.6% drop to a 0.5% drop. This means that in Australia, retail sales had the weakest quarterly growth in retail sales in years, highlighting the struggle households are facing due to high number of debt and low wage growth, which is weighing on consumer spending, and that in turn could weigh on growth. Also, we have the Reserve Bank of Australia policy meeting next Tuesday, so this data pretty much confirms that we're unlikely to see a rate hike in the foreseeable future, at least not next week. We can see the Aussie had rebounded yesterday on the back of strong construction data. It broke back about the 0.77 level. Now it slipped back below it, currently trading around 0.7680. And finally, looking at today's economic calendar, we've got UK services PMI coming up later for October, but the main focus will be the non-farm payrolls report that's due at 12:30 GMT, and we're also going to have Canadian employment data as well as the ISM non-manufacturing PMI. That's it from me. Thank you very much for watching and have a great day.